The High Court has ruled that all private hire taxi companies must pay VAT at 20% on their income as a result of a claim filed by Uber to level the playing field. My name is Jack Reeves and welcome to this week's episode of Tax Tidbits. So back in 2021, the Supreme Court ruled that Uber should be liable to pay VAT on their income as their drivers would begin to be recognised as workers, instead of being liable for their own VAT should they reach their £85,000 threshold. In response to this, Uber filed a claim to apply the same ruling to private taxi firms across England and Wales, which totals 16,000 businesses. As this has now been confirmed, cab firms may have to raise their prices by a fifth to cover these tax charges. Last year's inheritance tax stats have now been published and the results may shock you. In the year 2020 to 2021, only 3.73% of UK deaths were subject to an inheritance tax charge. This proportion has remained relatively consistent since 2018 because of the introduction of the residence nil rate ban, an allowance available for estates being passed to direct descendants on death. However, the total number of deaths that resulted in an inheritance tax charge increased by 4,000 to a 17% increase from last year. This caused the total inheritance tax paid to increase to 5.76 billion. This rise is due to the overall rise in UK deaths in this period, which is partly due to the effects of the COVID-19 pandemic. These statistics prove that although inheritance tax is one of the most feared taxes, most estates are not subject to the tax charge as a result of allowances and reliefs available. This week, the company Zoom, which gained popularity during the COVID-19 pandemic for remote working and family get-togethers, has told its workers living within 50 miles of the office that they have to stop working from home. This rule will apply for 2 days of the week as they plan on bringing in a hybrid approach to working. As you can imagine, this is rather ironic bearing in mind the company's foundation product, though they are hoping to utilise the change to continue to innovate and support their global customers. This week it was announced that the high street retailer Wilko has entered into administration after facing cash flow pressures as a result of inflation and rising interest rates. This decision puts 400 stores and over 12,500 employees at risk, although they do plan to continue trading without immediate redundancies as they hunt for a buyer. These economic problems can be clearly seen in their financial statements published on Companies House, as for the year to January 2022, the company generated a pre-tax loss of 38 million but still paid out dividends of 2 million to shareholders. Additionally, their cash at bank and in hand dropped by 46% from January 2021, hinting at the beginnings of cash flow issues. So while we might not see the chain disappear from high streets as yet, they have lots to do to get themselves into the clear. Wages rose by 7.8% in the April to June period this year, which has been the highest growth rate since records began in 2001. This rate indicates that there may be light at the end of the tunnel for those struggling with the current cost of living crisis, but this wage growth is not quite keeping up with the price rises currently. This increase has also fueled forecasts for the Bank of England to raise interest rates again to calm inflation. This is because as more people begin to afford to spend more money, companies will be raising their prices to match demand and to regain some of their profits. This domino effect can raise inflation rates and therefore the Bank of England may have no choice but to raise interest rates further in an attempt to douse the flames on creeping inflation. And that brings us to the end of another episode of Tax Tidbits. That is 2 episodes down and out on time, which is unusual for us. But we do hope you enjoyed our little nuggets of news, and if you found this video interesting, don't forget to hit that like button and subscribe to our channel. We'll be back again right here next Thursday, so make sure you do not miss it.